a new month and a new outlook, while more strategists rolling out their 2024 forecasts, and Wall Street patiently looking to see what could drive the markets higher or potentially what could bring the momentum to the downside here. Now, Charles Schwab's Sonders believing that economic pain could potentially be likely in the year ahead, but that doesn't necessarily mean that stocks are going to struggle through the year, especially if there is a continuation of rolling recessions that have hit the economy. We want to bring in Sonders. She joins us now, Charles Schwab's chief investment strategist. It's great to see you here. So let's talk about, just in terms of the most important factors or the driving factor for equities next year. What's on the top of your list in terms of what you're watching?
Well, I think clearly the move down in yields has been very important for the rally that started after the correction that ended in late October. So I do think that the bond market to some degree is in the driver's seat for the equity market. But obviously, I think the rally is also based on what is the current probability of rate cuts starting sometime in the first half of the year, maybe even the first quarter. I think that's a bit premature. We have to remember that probabilities around rate cuts have been a moving target for quite some time. We were back in March going through the mini banking crisis. It was expected that the Fed, as we talk now, would already have been in cutting mode, and that clearly was not the case. So I think the labor market is going to help provide clarity for the Fed. I also think that nearer term economic weakness, even a declared recession, oddly is probably the better scenario for the economy, for the Fed, for the equity market, than a recession that gets pushed further out, say into the latter part of 2024. So maybe a little pain might be necessary near term, but it's probably the better outcome.
I mean, that is welcome news to my ears this morning, Lizanne, because I think for a lot of people, they just have recession talk fatigue at this point, and we're kind of just sitting here waiting on the end of our chairs. When's it going to happen? We hear more calls this morning from Vanguard, mild recession perhaps next year. Raymond James, mild recession next year, and single-digit stock returns. So all of this considered, what would be the Fed's kind of purview that they would look to say, all right, we have enough data to ultimately say that we are in or are experiencing or about to experience a mild recession, and that we need to adjust course?
Yeah, and keep in mind that the official knowledge of a recession via a declaration and a start date given to us by the NBER always comes after the fact.
Right.
In fact, there are times where they've declared it, given us a start date, and it turns out once we found out the end date, at that point they declared it, we were already out of the recession. So I certainly wouldn't suggest sitting around waiting for that. I think what the Fed probably, the ingredients that are likely part of the recipe to not just stay in pause mode, which is justified, but actually pivot to rate cuts, wouldn't so much be a recession declaration. They know that's a lag in terms of the official nature of it. But to have both of their dual mandates sort of sending the right message. So inflation continuing to come down to, or at least closer to, their target in conjunction with more loosening in the labor market. They don't want to see a labor market that collapses, but they want to see a loosening. They want to see some more easing wage pressures. And I think once you have the combination of those two, then I think the Fed might start to telegraph easier policy. But probably the thought right now is stay in pause road and assess the so-called long and variable lags.
Lizanne, I think a lot of investors out there are trying to figure out exactly the best ways to play this market, given the uncertainty around the Fed, given the fact that we obviously don't know when exactly the rate cuts are going to start. We've seen some excitement when you take a look at some of those beaten down names like the Russell 2000, the small caps over the last several weeks. Are you seeing some tailwind there as we look ahead to 2024? And where else are you seeing those best opportunities?
It is interesting because over the past month, the Russell 2000 is actually outperforming the S&P 500. And I think that is indicative of some money that is looking to move into areas other than just the Magnificent Seven in the interest of seeing a broadening out. However, within that, I think you want to fade, to use trader lingo, the lower quality names that have done well, but continue to lean in up the quality spectrum. And one thing that's interesting about the Russell 2000 as an index, it's the most common small cap benchmark that's used. But there's also the S&P 600 as an index. And the only reason I mention those two is that Russell doesn't use a profitability filter. There's close to 40% of stocks in that index that are not profitable. 31% of stocks in that index are zombie companies versus the S&P 600 that has a profitability filter. And as a result, it's trading at a multiple about, 8 or 9 points lower than the Russell 2000. So I'm not recommending the index, but if you're looking for an index as a source for ideas, inherently you have a higher quality index with the S&P 600 because of that profitability filter.
Lizanne, just lastly, while we have you here, we're in the holiday spirit. I mean, we're getting close to the end of the year. We're trying to put together some New Year's resolutions. Mine is to just say serenity now, just a little bit less next year. And for that, I need a top idea. What is your top idea kind of getting into 2024?
Discipline. I think this is the time for discipline, risk management, and it's about diversification and rebalancing. That's the best way to navigate through an uncertain environment.
Lizanne Sonders, Charles Schwab, Chief Investment Strategist. Great to have you here this morning. We appreciate the time.